Hey, great to have you, Peter.
Good to be
So,
here.
uh, why don't we start with this? I follow your writings and the emails that you put out, Peter, and one question that really came to mind to me today, and I'm trying it. I've tried it. Um, you're buying U.S. dollar yen, aren't you?
Um, no, I actually like the yen here.
Yeah, that's what I mean.
Yeah, yeah,
So,
yeah. I, 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 I think there's an extraordinary amount of pressure on the Bank of Japan to act robustly in July. I say robustly because they're probably not going to raise interest rates much. Maybe they raise them 10 or 15 basis points, not as much as 25. But I do think we see a bigger than expected cut in QE. I think that the Ministry of Finance does not want to be put in a position of having to defend
intervene.
and constantly intervene because we know and they know through experience that it never works more than just a couple of days. And I think that the Japanese people are getting pissed with the weakness in their purchasing power, with wage growth still running below the rate of inflation. And
Okay,
we're at an inflection point. So, um, it is a
those are
widow
good
make or
reasons.
trade potentially. So it's
Mhm.
not something that you have to be too confident in until you see what the Bank of Japan does. But that was just some of my thoughts.
Okay, so it's something that you're considering. You haven't stepped in. Are there any levels
Well,
that?
I do have some yen exposure through. I recently bought 7-Eleven, well, the company that owns 7-Eleven. So that
Okay,
was my wussy way of getting some yen exposure.
okay, all right. Because I think there are some people talking 62 to 64 since we made new highs. On the daily, I'm seeing some pretty good divergence here. And you know what? A lot of people are waiting till mid-July. What if they do both? What if they try an intervention during the holiday period next week? And then go ahead and back it up with some fundamental shifts like you were talking about. Maybe,
I think they would actually get more bang for their buck slash yen if they intervened after they raised rates, because you
I
could
see.
have, because there's no point in intervening, then acting monetarily and not satisfying the market, and that intervention was wasted. It's better to see maybe react first with monetary policy, try to develop some momentum with the strength of the yen, then intervene to further that momentum. That's what I would do if I was running FX policy there. So, but
Okay.
I doubt they intervene prior to this meeting, but I could be wrong.
I mean, look at this. I mean, this last high in the end on the weekly um, hasn't even gotten above 70, where you look at prior highs, the high on the intervention was above it. So we are diverging between a lot of highs here, getting some momentum, non-confirmations, but we still need a red candle, some kind of weekly red candle to confirm it for the price to confirm. You have a view on yields here in the States, Peter? We've had a
Uh,
nice bond
I
rally
Yeah,
in TLT.
I still think that the 10-year yield is going to be retesting 5%, the level that we saw last October. I don't think that this bond bear market is just magically over in a couple of years after a 40-year bull market. I think that there's a lot more wood to chop here on the long end of the curve. And whether that is because, while I acknowledge inflation is definitely moderating, uh, I don't necessarily think that that is sustainable. I watch very closely the weekly uh, container price index, and it just
Yes,
continues to spike. It's doubled, more than doubled over the past 10 weeks. If you look at the Shanghai to Rotterdam route, it's doubled from Shanghai to LA. Goods prices, we know, we on a year-over-year basis, it's back to its pre-COVID trend, but basically zero. But I don't think we stay here, in part because of higher container prices. We've been in a global manufacturing recession for 2 years that
yeah,
at some point will end, and we'll see some restocking. Oil's still remaining stubbornly here at around 80-ish. Now, on the flip side, we are going to flow through the weakness in rents we're seeing that will slow the services side of the inflation story. But I think net net, we're still in a 3 to 4% sustainable inflation rate. I emphasize sustainable because we're going to see two prints in the second half of the year, but mid to high twos. 3 to 4 to me is a more sustainable inflation rate over the next couple of years. And the other reason why I like tips here. And higher for longer is not just a worn out cliche, it's going to be for real.
Okay, well, all I know is technically, Peter, if we take out 420, that's a huge level if you look left that we held in the last week or so. That's going to be a breakdown to me. And that measures back down towards the lows of, 360. I don't know. Can you come up with a narrative that could get us there? You
Well,
can't
you,
because
you
you
can
just
have,
laid out the case. The technical argument.
well, if we go into a deep recession,
Okay.
the flip side of that, though, is if you go into a deep recession, instead of having $2 trillion budget deficit, you're going to have a $3 trillion budget deficit. And as a percent of GDP, it'll be over 10%. And that the amount of supply can just overwhelm the market, and you can have a recession but higher long-term interest rates. That's
Okay.
very emerging market-like
Okay.
scenario, but I
Yeah.
can't rule it out.
Okay. Yeah, I want to talk to you about this real estate because you make a great point that in the inflation figures that the government uses, they use rents instead of housing prices.
They're lucky they use
That,
rents because if they used housing
yeah, right,
prices, inflation
right,
would have been double digits in 2022.
right.
The
Rent,
case, I'm
yeah.
sorry,
Go
the
ahead.
S&P Core Logic home price index since February 2020 is up 48%. Rent of a primary residence within CPI is up about 23%. So the Fed is lucky that they use rents
Okay.
from an optics standpoint.
We all know the argument of housing stock and low supply, and that's a bull case. Um, can you come up with a narrative on how the real estate market could begin to decline and even enter a bear market in real estate? Could it be that if the consumer that took their revenge trips last year, Airbnb and a lot of these homes that have been converted into vacation rentals, if they're not being used, that they could be additional supply on the market? And, the argument of demographics being lousy here in the US doesn't exactly jive with the housing shortage. Where are all the people coming? And houses never die, just the residents do. Can you come up with a case that would um, create what a lot of people have been talking about for a few years and they were wrong about the housing market entering a bear phase and prices declining?
Well, I actually would argue that lower home prices would actually be a good thing because, well, not like, of course, it was in 2008, but the housing market's upside down. The pace of existing home sales is at a 30-year low. We need lower home prices to reset the housing market, to give first-time home buyers an opportunity to own a home. Because not only, of course, do you have the 48% rise in home prices, you've more than doubled mortgage rates. You need lower home prices to offset, well, to make it affordable again. Because for every transaction of a home that does not take place, the buyer of that home is not going to repaint the walls. They're not going to be putting down flooring. They're not buying new furniture. The
Right.
seller of the home that's moving into another home, well, that's another transaction that's not taking place. We need more housing transactions, and a decline in home prices is the only thing that will get us there.
How can that
And
happen with the the shortages that we've been hearing about in housing stock? How can we get a bear declining price structure in real estate? A
we need
recession,
baby
is that the
boomers.
only answer?
No, we need baby boomers to downsize. Now
Okay.
that's not something that happens with a snap of a finger. This is a multi-year process. But the 70-year-old baby boomer needs to downsize. The kids are out of the house. It's time to sell, and it's time to buy a place in Florida. That's what we need in the existing home sale market. But again, as I said, not something that happens overnight. It's a multi-year process.
Okay, you don't think the vacation rental market, as it becomes less uh, profitable and even losses for people that went out and bought a lot of places and turned them into vacation rentals, would be enough new supply to come on the market if they decide they're not getting enough revenue to support what they're paying on the mortgage for their vacation rentals?
No doubt that all the Airbnbers could run into trouble if there's a slowdown in rents, for sure. I can't discount that. I think also another factor that will determine the state of the economy and a byproduct that being housing is what happens to the stock market. What
Okay,
happens if the
the
S&P
wealth
500
effect.
goes to 3,000 or back to 3,500?
Okay,
Um, that also will impact people's lifestyles. And if those boomers still have a lot of assets in the stock market, if you see a decline in the market that impacts their retirement, then yeah, maybe they'll be more inclined to sell that house. Now, that is more housing supply for wrong reason. So
okay,
there are a lot of different scenarios that can play out here.
okay. Uh, Interesting. So let me ask you, Peter, about things like, dare I say, NVIDIA. Do you think that we're seeing some topping action in the market? And I want to congratulate you on, I'm sure you're still long metals. Before we get to that, though, can we talk about the stress tests yesterday? Because that also relates to, credit issues with commercial. And so far, you have any reaction to the stress tests? I know that regulators came out and said that most banks are pretty prepared for deterioration uh, of their books if credit on especially the poor consumer that's pretty maxed out, if they start to walk away from debt, that all the banks are okay.
I had a big yawn when the
Yeah,
stress
big
test
yawn.
came out.
Okay.
There's no doubt that consumer delinquencies are going up for credit cards, for auto loans. Uh, we obviously have to pay attention to what the rise in interest rates on a sustainable basis is going to have for corporate credit, commercial real estate. Of course, there are going to be more banks that fail. There's no doubt about it. But uh, it's when you have more than 4,000 banks and you see a vertical rise in interest rates, yeah, there are going to be banks that fail. We already saw that, obviously, March of last year, and we'll see more.
Yeah.
But in
So
terms
the
of
little banks are history then,
yeah,
KRE.
but what we've seen though is that the U.S. government has essentially guaranteed everyone's deposits implicitly. They're not going to bail out Silicon Valley deposits and then not bail out a mom and pop. That's not going to go over well politically. So if you've essentially guaranteed everyone's deposit, well, if there's a failed bank, then they'll just merge it into another one. I think most importantly with the banking system is that they clearly are more focused on their balance sheet. They've slowed the rate of lending. We've seen a notable fall in auto loans. We've seen a topping out and a rollover in real estate loans. They stayed elevated because a lot of the pre-commitments that banks had on projects that started pre-2022 are now finishing up. CNI loans have been sort of in a range, but a lower it's still down well off its highs. Credit card loans are still up because that's people are still using credit cards, but that could also be part of a secular story where people are just using more credit than cash. But I think it's clear that banks have dramatically tightened standard. It's much harder to get a loan,
Yeah.
and but that's been an ongoing story for the past year plus.
Okay. Is the story changing here? NVIDIA being
Um,
the darling. What,
so
key reversal. Uh, Last time we saw something like that was back here. We had about a 20% correction, and then it took off again. Um, what do you think with tech, the concentration in tech? If this is one of the reasons, the most valuable company on the globe, could this be the um, canary in the coal mine?
Well, it certainly is if it falters. I mean, I think, technically speaking, there's no doubt that NVIDIA has gone parabolic.
Yeah.
But on a valuation basis, valuations don't matter until they do, and they only do when uh, earnings growth rates start to slow. NVIDIA hasn't seen that yet, but just for some perspective, I went back and looked at Cisco's peak
Okay.
price to sales ratio in 2000 was 23 times. I'm sorry, 24 times sales. Now, I don't want to hear what NVIDIA's PE multiple is on 1 year's earnings and someone telling me, oh, it's very reasonable. It's only reasonable if you think that a 76% gross profit margin is sustainable, which it's not for NVIDIA because you have NVIDIA's biggest customers today trying to develop their own chips, which will
Okay.
then be their greatest competitor tomorrow. So so I'd rather price NVIDIA on a price to sales basis. So today's multiple for NVIDIA on fiscal year 25, which ends January 2025, the estimate of $120 billion of revenue, which is double the year before, NVIDIA is trading at 26 times sales. So
Okay.
there
More than
is
Cisco.
there's no room for error. Like I said, their biggest customers are trying to be their competitors. It's an amazing fundamental story today. The question is what do you pay for that? That's the debate. No one's debating the positive fundamentals of NVIDIA right now. They're robust. The debate is what do you pay for that? And I think we've reached epic height phase in everything AI. Obviously, the CapEx component, which NVIDIA is benefiting from, has been extraordinary. But I think it's highly uncertain of what the payoff is going to be in terms of return on investment and what's the usage. Everyone's going to use AI in some fashion, but is it just a tool that we use along with other pieces of software? I think that's the case, which is still very helpful, makes us more productive, and it will. But so, technology and software, it's been perpetual pace of innovation that makes our lives more productive. That's been going on since the history of the world.
Yeah, quantum computing can dwarf what AI is. Have you looked into it at all?
Yeah, but to me, I can't put my arms around that just yet in terms of timing and what it all means. To
Yeah,
me,
you
that's
have to
more of
be
a longer drawn
Oppenheimer.
out. Yeah,
You
it's
have
a
to
more of a
be
drawn out part. Yeah, so I can't quantify that just yet.
okay. And why don't we touch on the commodity markets? They've kind of been in pullbacks. Gold's having a decent day here today, keeps holding this 2280 level. Do you have to be a buyer on breaks, right, Peter? I mean, this is not the end
Yes.
of the run. Same for
No,
silver,
silver's peak in 2011 and 1980 was 50.
right
Today
there.
it's 30.
Right.
And gold to me still has a lot of upside. You just inflation adjust gold for the 1980 high, and you're talking 3,200 gold, amongst other fundamental factors that can get it much higher than it
O-
is today. So we remain very bullish and long, both the physical and the miners.
Okay. What miners do you like?
The big ones like Agnico, um,
Okay.
Seabridge, which is more of a development company. And some of the ETFs own a basket of it. So I think you're fine with Newmont
Yeah.
and Alamos and Barrick, all the big ones.
Yeah. When you look at Newmont compared to what gold did, it didn't do much, did it? Here's a monthly chart. But GDX, look at this formation, Peter. This was the COVID low and the first rally, and we've been compressing in this huge triangle. And it was turned back at the triangle line. I'm thinking if we pull back towards 30, which is, 10% from here, that you have to back up the truck for a buy there for an eventual breakout. The breakout's going to be pretty big too, isn't it? 44, that's 28. You tack on 28 to 34, it gives you like 72, which will take out the 2011 highs. Just so
Yeah,
that,
and GDXJ, the smaller miners, the junior miners, there's
yeah,
notable upside as well.
okay. Um, do you think that Vol is dead, Peter, or is the second half going to be a little messier uh, than the first half?
Probably. When you take a step back on the market here, is that AI gave the market a second wind. There were two things with the market that when the S&P got to 3,600-ish in October 2022, it the bottom in the stock market, the top in the dollar, was when the Fed gave us sort of their last 75 basis point rate hike, and the market sort of sniffed out that from here the pace of rate increases was going to slow. And then you throw in AI in the beginning of 2023. That is what gave the market a second wind. And here we are now with extraordinary AI valuations that you need the rest of the market to get a second wind because the Russell 2000 is down on the year. We all know about the
Yeah,
divergences. We all know the equal weight S&P is dramatically lagged. Like you just can't have that disconnect for so long because, and I've said this before, that Google, Microsoft, Apple, Amazon, they don't breathe their own economic air. We all breathe the same economic air. Who's who's a lot of the customers buying software from Microsoft? It's small, medium-sized businesses. Who's advertising on Google and Meta? It's small, medium-sized businesses. So how can you have those stocks continuously going up and their customers' stocks and continuously go down? It's not a sustainable trend. And I know that technical analysts will talk about the implications for that side of where stocks go. I am focused on the fundamental divergences. It's just not sustainable. And I'm hoping that the small mid cap values markets catch up rather than the big names catch down, which they could. But those are things that we have to watch right now.
yeah. I know a lot of people coming into this year were so optimistic about the Russell. I mean, people talking about it doubling, and it's still been a disappointment for people along Russell. What could change it? And you know what? I'd like to wrap it with Peter and viewers. Here's Peter's report where you could find his stuff. I get his emails. You need to do it too at the book report. But why don't we kind of focus on what's happening with the dollar, which, is a linchpin here. We're threatening an upside breakout here in the dollar. Today we're getting a little down day, but above 650, it's going to look pretty good. I'm currently short the dollar. I'll be out over this level. Um, what would be the narrative to for the dollar to break, and would that be supportive, or could we actually have a time where people are their recency bias is risk off by the dollar? Could we enter a phase where there's risk off and the dollar is lower on risk off because people are leaving dollar denominated assets?
I like to look at the dollar against specific currencies. Um,
Okay.
the dollar yen has
Euro.
its own dynamic based
Right.
on what the BOJ is going to do here. I look at the euro and you take a step back on a 5 year basis. Uh, the euro is traded between call it 105, a dip below par,
You're right. It's
very,
been in
very
them.
temporarily in
Yeah.
2022, but it's been traded between call it a buck and a buck 25 for
Yeah.
years now.
Forever.
And
Yeah.
and we're kind of stuck in the middle. So what does that tell me? You look at the Canadian dollar. We've been in a trading range for years now. Now the peso has recently weakened with the election results, but
Right.
prior to that, the Mexican peso was very strong against the dollar. The pound has sort of been in a range for the last couple of years, though down from where it was during the Brexit vote. So, the dollar has its own major issues. And I think that's why outside of the yen, in terms of the major currencies, hasn't really broke out against anything.
Okay. So basically, central banks have been, what you described was success by the central banks to take the volatility out of currency trading. That they've
Yeah,
been able to, all majors have been range bound for a long time.
that's what it seems. I mean, it's been a very, I mean, you look, the dollar has been just, it's been a very interest rate differential
Yeah,
factor move here. The dollar bottomed in June 2021, just as Jay Powell said, we're thinking about tapering QE. The
right.
dollar topped in September, October, maybe early November
Yeah,
2022, just as the Fed was ending their, as I said, their last 75 basis point rate hike. Uh,
right here.
it's just been very interest rate differential influences here with the dollar. And now that the Fed's going to cut at some point this year, so that takes some of the steam out of the dollar strength, even though obviously it's bounced a little bit here the last couple of weeks.
Yeah,
But so
I'm bearish.
yeah,
I think that,
I
if we
think
start
easily
taking
roll
out
over.
105, then 104, we're headed towards par. And if we take out this 106.50, probably headed up to 108, 110. So it's at a critical juncture here, just like the yen is. Why don't we wrap it with, um, I know we have a debate tonight. Do you think this election is going to have any major impact on what happens with confidence in the markets, et cetera? Do you have any views on uh, whether this is just going to be smooth sailing and both sides accept the result and it's not decided by the Supreme Court and the markets, just like they've ignored wars that are escalating, will ignore this too?
I'll say I hope so.
Okay, but do you think so?
Um, I don't think that there's going to be another election issue.
Okay,
I think there have been a lot of on the ground adjustments um, to this to sort of clean up any possible irregularities that people alleged. So I'm hoping that the system, so to speak, is much more prepared for providing clean outcome that both sides can happily accept.
from your lips,
Well,
Peter.
I should say the winner will be happily accept, the loser won't. But
Right.
I'm hopeful that it'll be clean.
Any worries about the escalation of geo risk?
Um, Historically, geopolitics matters for a week because unless it directly impacts economic activity and the disruption of shipments and supplies, it doesn't have an impact. But we've clearly have seen
Yeah,
disruptions
your
here. I mean,
shipping
the
rates.
Houthis, you're right, the
Yeah,
Houthis are resulting in another spike in shipping costs. Obviously, things can happen with Russia and their delivery of energy. So, more so than in a while, the geopolitical threats here are lasting longer than what it does normally.
right. So if the Houthis can disrupt shipping, what could the Iranians do, which are, you know, they're puppet masters?
Well, what's most scary in the world we're in now is all you need is a drone to cause a major disruption.
Yeah. Okay. So I really appreciate you being here, Peter. And the yen is, you know, I'm break even from yesterday now. Anyway, it's always great to talk to you. I encourage people to go to Peter's book report. I mean, what you're getting as a retail guy is stuff that institutions pay for. So appreciate you, Peter. Thank you very much for edifying the community and answering every question I throw at you.
Dale, I appreciate having me on as always.
All right, buddy. Have a
All right, take
great
care.
summer. We'll talk in the fall.
Sounds good. Thank you.
Peter Boockvar, everyone. Follow him on X at P Boockvar. And that's going to be a wrap for us today. Good hunting, everybody. The rest of the day, we'll wrap it up with the inflation number and TGIF tomorrow. Don't just count your barrels of oil or your coins or your pips, count your blessings. Adios, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.